I want to share with you guys today 10 truths of how the stock market functions and behave. Chapter 8 of Benjamin Graham's The Intelligent Investor is widely considered one of the most important chapters ever written on investing. In it, Graham introduces his famous allegory of Mr. Market to help investors deal with the emotional roller coaster of stock price fluctuations. Here is a breakdown of how the concept works, why Graham created it, and how you are supposed to use it to your advantage. The Mr. Market allegory. Your manic business partner. Imagine you own a small private business with a partner named Mr. Market. Every single day, Mr. Market shows up at your door and quotes you a price at which he is willing to either buy your share or the business or sell his share to you. The catch is that Mr. Market is intensely emotional. When he is wildly optimistic, manic, he sees only a golden future for the business. On these days, he quotes an absurdly high price because he's terrified you'll buy him out and take all the future riches. When he is deeply pessimistic, depressive, he sees nothing but disaster ahead. On these days, he quotes a ridiculously low price because he is terrified of being trapped in a failing venture. No matter how many times you tell him no, he never holds a grudge. He always shows up the next morning with a brand new price. And the three key lessons for the intelligent investor. Graham uses this story to shift how we look at market volatility. The core takeaway can be boiled down to three structural rules. First one, Mr. Market is there to serve you, not to guide you. Most everyday investors look at failing stock prices and think, oh no, the market knows something I don't. I should sell before it drops more. Graham says this is exactly backwards. Mr. Market is not a wise teacher. He is a liquidity provider. His daily prices tell you absolutely nothing about the actual long-term intrinsic value or the real worth of the business. They only tell you how he is feeling today. Two, you have the ultimate advantage. Absolute freedom. You are under no obligation to agree with him. If his price is crazy high, you can happily sell your shares to him and pocket the premium. If his price is crazy low, you can buy more shares on the cheap. If his price is just ordinary, you can completely ignore him and let your business generate its normal profits. Like Benjamin Graham said, the investors who permits himself to be stamped or unduly worried by unjustified market declines in his holdings is perseveringly transforming his basic advantage into a basic disadvantage. In number three, price versus value are two completely different things. The stock market is essentially a giant voting machine in the short run, measuring popularity and emotion, but a weighing machine in the long run, measuring actual business earnings. Mr. Market represents the voting machine. Your job as an intelligent investor is to focus on the weighing machine. Truth number one, the stock market is a device to transfer money from the impatient to the patient. That famous quote is actually attributed to Warren Buffett, Benjamin Graham's most successful student. And it is the perfect companion piece to the Mr. Market allegory. It cuts straight to the psychological core of building wealth. To break down exactly how this transfer works, look at why the structure of the stock market naturally rewards patience and penalizes impatience. How the device transfers wealth. The stock market is a highly liquid environment where billions of dollars change hands in milliseconds. This friction-free environment creates an illusion that investing is a fast-paced game. In reality, that liquidity is the mechanism that facilitates the wealth transfer. The cost of overtrading. Overtrading has a cost. It comes with the cost. The impatient market participants treat the stock market like a casino or a real-time scoreboard. They react to every piece of news, every macro scare, and every price swing. This leads to chasing performance, buying an asset after it has already surged because of fear of missing out, FOMO. Selling an asset at the absolute bottom because a temporary drop causes fear. Friction costs. Even in a world of zero commission brokerages, frequent trading incurs hidden costs like the bid-ask spread, and most importantly, short-term capital gain taxes, which severely blunt the power of compounding. The premium earned by the patient investor. Patient investors view a stock not as a bouncing ticker, but as a fractional ownership stake in a real business. They do the heavy lifting upfront by analyzing the business, determining a reasonable value, and then they wait. When the impatient panic and dump high quality assets during a market correction, the patient are sitting there with cash ready to buy those assets at a deep discount. The patient investor essentially extracts a premium from the impatient person's need for immediate relief from anxiety. If you look at the empirical data of market history, the stock market heavily penalizes short-term emotional trading and consistently rewards long-term holding. The impatient investor panics and sells during the dip. The patient investor buys the discount with liquidity. However, there is one critical nuance where people misinterpret this quote. The dynamic of passive versus active patience. Patient in investing is only a virtue if you are holding a productive asset. Blind patience, holding a fundamentally broken, failing business all the way to zero, is not the kind of patience Buffett is talking about. That is just stubbornness. Strategic patience. This means having the discipline to wait for the right price to buy, the emotional fortitude to do nothing when the market enters a temporary downturn, and the clarity to let compounding do its job over years, not over days. Like Philip Fisher said, the stock market is filled with individuals who know the price of everything but the value of nothing. Ultimately, the market is a psychological arena. The impatient person pays a premium for certainty and speed. The patient person collects that premium by managing their emotions and focusing on long-term compounding of real business value. Truth number 2. The stock market is a voting machine in the short term and a weighing machine in the long term. And this is another brilliant insight from Benjamin Graham's The Intelligent Investor. He used this exact analogy to distinguish between speculation, guessing where a price will go next, and investing, evaluating what a business is actually worth. To understand why this is one of the truest statements ever spoken about finance, we have to look at what is actually being measured in the short term versus the long term. The short term is a voting machine. In the short term, days, weeks, or month, the stock market is essentially a massive real-time popularity contest. The price of a stock doesn't reflect the underlying health of the company. It reflects the aggregate emotions, opinions, and biases of everyone trading it. How votes are cast. Investors vote with their capital based on fear, greed, hype, headlines, and momentum. The flaw of the voting machine, it is highly irrational. If a company releases great earnings but macro news is bad, people panic vote and sell. If a company is losing money but has a massive social media hype cycle behind it, people greedily vote it up. The result? Stock prices swing wildly away from reality because the voting machine measures sentiment, not substance. The long term is a weighing machine. Over the long term, typically on a horizon of several years, the noise fades away. The market stops asking, is this stock popular? And starts asking, how much cold, hard cash does this business actually generate? What is being weighted? The weight of a company is its fundamental financial reality, its revenue growth, profit margins, free cash flow, and return on capital. The law of gravity in finance. A company cannot outrun its financial reality forever. A hyped up business with zero earnings will eventually get weighted and found wanting, causing its stock to collapse. Conservatively, a boring, high profitable business that is ignored by the crowd will eventually force the market to recognize its value through dividend payouts, share buybacks, or sheer earnings power. In the short term, sentiment drives price. In the long term, earnings drive price. This principle is the foundational bedrock of all value investing. If the market were only a weighing machine, there would be no opportunities to beat it. Every stock would always be perfectly priced. If it were only a voting machine, investing would be pure gambling. Because it is both, it creates the perfect setup for disciplined investors. How do you use this to your advantage? Understanding this duality changes your entire relationship with market volatility. You exploit the voting machine. When the voting machine is panicked and irrational, it throws high quality, high earning businesses into the discount bin. That is your cue to buy. You trust the weighing machine. Once you buy a solid asset, you don't panic if the price drops the next day. You hold it because you know that eventually the weighing machine will correct the mispricing and reward the company's real underlying value. As Graham's star pupil, Warren Buffett, famously put it, look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. Truth number 3. The stock market is a device to transfer money from those who look for short-term gains to he who is focused on long-term wealth. The income engine. This portion of capital is actively managed to extract premium from the market's short-term volatility. It treats Mr. Market's daily manic mood swings as a source of cash flow. For someone leveraging geographical arbitrage, living in a lower cost hub while earning in a stronger currency, this engine provides the immediate, reliable liquidity needed to fund daily operations. The wealth accumulator, the later money. This portion is completely insulated from the short-term noise. It is left alone to sit in the weighing machine of the market, benefiting from the full, uncapped upside of growing enterprises. The market will absolutely strip wealth away from an investor who is intentionally forcing short-term income out of the market throughout reckless overtrading, bad timing, or chasing unsustainable double-digit yields that erode their principal capital. But if an investor is disciplined, treats cash flow generation as a structured business, and uses a portion of that income to consistently fuel a long-term wealth portfolio, they aren't losing the transfer. They are mastering the machine. Truth number 4. The stock market is a device to transfer money from those who do not have cash reserves to he who does. This is a brilliant and very accurate reframing of the quote. When we say the market transfers money from those who don't have cash reserves to those who do, we are hitting on a structural mathematical reality of how wealth is shifted during market cycles. While the original quotes focus on the psychology of patience, this version focuses on the tactical engineering of investing. Patience is a luxury, and in the stock market, cash reserves are what buy you that luxury. Here is exactly how the market acts as a giant siphon, transferring wealth from the cash poor to the cash rich. The forced seller versus the opportunistic buyer. When Mr. Market goes into a depressive panic and asset prices crash, everyone is hit with a paper loss. But what happens next depends entirely on your cash reserves. The investor with no cash reserves. If an unexpected expense hits, a dry spell in business or an emergency, they are trapped. They don't have a liquidity buffer. To survive or cover their expenses, they are forced to sell their stocks at an absolute bottom. They lock in permanent losses, not because they want to, but because they have to. The investor with cash reserves. This investor has an emergency fund or a dedicated pile of dry powder, cash waiting for an opportunity. When the crash hits, their daily life is completely unaffected. They don't have to touch their portfolio. Instead, they can look at the discounted market, deploy their excess cash reserves, and buy up those high-quality assets at a steal, the transfer. The cash-poor investor is forced to hand over valuable, undervalued shares to the cash-rich investor just to get immediate liquidity. The options trading and the margins of safety. This transfer becomes incredibly obvious when you look at active cash flow strategies like selling covered calls or utilizing options leverage. If you write options or run an income-focused portfolio without sufficient cash reserves, you are playing a highly dangerous game. A sudden market move against you can trigger a margin call or force you to buy back contracts at a massive loss just to prevent your account from blowing up. Conversely, an investor who keeps strong cash reserves can easily weather short-term volatility. They can safely hold through a dip, collect their premiums, and let time decay work in their favor. They essentially extract a premium from the less capitalized traders who are forced to buy expensive insurance options to protect themselves from the risk. Cash is the fuel for patience. You cannot be a patient investor if you are worried about how you are going to pay next month bills. No cash reserves, that means vulnerable to volatility. It is forced to sell low. Result, wealth loss. Transfer to strong cash reserves. Peace of mind, dry powder, able to buy low, wealth gained. By maintaining deep cash reserves, you insulate your investments from your personal liquidity needs. It ensures that you are always the one dictating terms to Mr. Market rather than letting a temporary lack of cash force your hand. Truth number 5. The stock market will always humiliate you. The stock market is a masterclass in humility. If you stay in the arena long enough, it will eventually find your blind spot and expose it. It is important to put a perspective to this. The market doesn't humiliate you out of malice. It humiliates you because it is a complex, adaptive system that changes faster than the human ego can adjust. When investors experience market humiliation, it almost always happens through a few very specific, repeatable psychological traps. Trap number 1, the trap of the genius bull market. There is a dangerous psychological phenomenon in investing, confusing a bull market with personal financial genius. When a sector or an index is ripping higher, almost every strategy looks brilliant. An investor selling cover calls or riding a massive tech surge can easily start to feel bulletproof. The ego kicks in, and they assume their recent profits are due to superior intellect rather than a rising macro tide. Just when an investor feels invincible and starts taking on bigger risks, dialing up the leverage, or cutting down their cash reserves, the market shifts. A sudden rotation, an unexpected regulatory curveball, or a macro shock hits. Market instantly strips away those gains, delivering a sharp dose of reality. Number 2, pushing conviction into stubbornness. Another way the market humbles people is by weaponizing their own conviction against them. You can do flawless, fundamental research on a company, understand its intrinsic value inside and out, and buy it at what you think is an absolute steal. But As Benjamin Graham taught us with Mr. Market, the voting machine can stay irrational a lot longer than you might expect. If an investor gets stubborn, refuses to acknowledge changing structural realities, or fails to respect the market's price action, the market will happily keep grinding against them until they are forced to capitulate. The market is essentially a mirror. It reflects our greed back to us as losses, and our arrogance back to us as missed opportunities. Accepting that the market has the power to humiliate you isn't about being fearful, it's about respect. The moment an investor loses respect for the market's capacity to surprise them is exactly the moment Mr. Market steps in to teach a very expensive lesson. And truth number 6, it appears that the stock market is always a step ahead of you. This is a core truth of modern finance. The phrase the market is always a step ahead is the practical, everyday way of describing the efficient market hypothesis. The moment a piece of news becomes public, whether it is an earning report, a change in interest rate, or a geopolitical event, the market prices it in almost instantly. If you are reading about a piece of news on a mainstream financial site or social media, you are already too late to trade on it. The market has already taken that step. Understanding why the market stays ahead reveals how retail investors can stop trying to race it and start winning on their own terms. Why is it that you can't outrun the market? The stock market isn't a collection of slow-moving individuals. It is an aggregate network of massive institutional capital, supercomputers, and algorithms. The speed advantage. The modern market operates in milliseconds. High-frequency trading, HFT, algorithms are co-located inside data centers right next to exchange servers. They scan news feeds, interpret headlines using natural language processing, and execute multi-million-dollar trades before a human can finish reading the first sentence of a headline. You cannot beat a machine in a sprint. Number 2, the market doesn't price assets based on what is happening today. It prices them based on the collective expectation of what will happen 6 to 12 months from now. This is why a company can report record-breaking earnings, yet its stock price drops because its forward guidance missed expectations by 1%. This is why the stock market often starts rallying in the middle of a brutal economic recession. It is already looking ahead to the eventual recovery. How to win when you are always a step behind? If the market is always a step ahead, how does anyone make money? The secret is simple. You stop trying racing it in the short term, and you choose a game where speed doesn't matter. You see, the short-term sprint causes the reaction trading, and you lose the machine domain. You lose because it is a domain of the machine, but the business reality, the compounding equity, is a marathon, and right there you win. Shift from a sprint to a marathon. While the market is incredibly efficient at pricing in immediate news, it is notoriously bad at pricing in long-term human behavior and the true compounding power of an excellent business. Accept the price. When you buy a high-yield ETF, a core index fund, or a solid blue-chip stock, accept that the current price is a fair reflection of all known public information. Play a different game. Your edge isn't knowing the news first. Your edge is having the discipline to stay invested, systematically utilizing dollar cost averaging and generating cash flow through options premium while letting time do the heavy lifting. The market can stay a step ahead of your trades, but it can never rob you of the compounding returns of a productive asset. If you refuse to play, it's a short-term guessing game. And truth number 7, the stock market can stay irrational much longer than you can stay solvent. This is perhaps the most famous warning in all of finance, usually attributed to the legendary economist John Maynard Keynes. This quote is the ultimate reality check for anyone who thinks they can outsmart the market based on pure logic. It means that even if your analysis is 100% correct, even if a stock is mathematically overvalued and bound to crash, or deeply undervalued and bound to rise, the market can continue to move in the wrong direction for far longer than your brokerage account can survive the financial pressure. To understand why this happens, we have to look at the explosive friction between theoretical logic and liquidity mechanics. The trap of shorting an irrational market. The absolute clearest example of this rule happens when investors try to short a hyperbubble. When you short a stock, you borrow shares to sell them, hoping to buy them back later at a lower price. If the stock goes up instead of down, your losses are theoretically infinite. Imagine you spot an asset that is completely decoupled from financial reality. It's losing money, yet the stock is skyrocketing due to social media hype or manic retail herd behavior. You shorted at $50 a share, knowing its true intrinsic value is closer to 5. The logic. You are completely right. The company is a hollow shell. The humiliation. Instead of crashing, the mania intensifies. The stock surges to 100, then 200, then $400 a share. Even though you are fundamentally right about the long-term destination, your broker doesn't care about your long-term thesis. They look at your mounting paper losses today. If you run out of cash reserves to maintain your margin requirements, you get hit with a margin call. The broker will forcefully liquidate your position, locking in a catastrophic loss. 2 months later, the company might file for bankruptcy and the stock goes to zero. But you aren't around to collect. The market's irrationality outlasted your solvency. Number 2, leverage is the catalyst for insolvency. This rule applies heavily to options trading and any strategy that utilizes leverage or borrow money. When you use leverage, you compress your timeline. You no longer have the luxury of sitting back and waiting for Benjamin Graham weighing machine to correct the market's pricing. You are bound by expiration dates and margin maintenance thresholds. If you sell options for short-term income, a temporary, highly irrational macro panic can cause premium prices to spike or asset values to drop violently. Even if the market completely recovers a week later, a lack of deep cash reserves during that brief window of peak panic can cause an account to blow up. How to protect yourself from the market's irrationality? The only way to beat a market that can stay irrational is to build a portfolio architecture that removes the clock. If the market cannot force you to sell, its short-term irrationality cannot hurt you. A vulnerable portfolio or a anti-fragile portfolio. A vulnerable portfolio with high leverage, low cash reserves. A good portfolio, zero leverage, deep cash reserves. The first one is bound by dates and margin. The second, if you buy high quality assets with cash, no margin debt, Mr. Market can price them at pennies tomorrow morning and it doesn't matter. You still own the fractional shares and you can comfortably wait for reality to catch up. Maintain deep cash reserves, keeping dry powder and source that a temporary irrational spike in market volatility is met with calm execution rather than panic or a forced margin liquidation. Size positions defensively. When running active income strategies like selling covered call or puts, ensure individual position sizes are disciplined enough that an extended period of market craziness won't compromise the core capital pool. In a battle between logic and the market's liquidity, liquidity wins every single time. Being right at the wrong time is functionally identical to being wrong. To survive, an intelligent investor designs their strategy around a simple premise. Expect the market to be completely irrational, and so your portfolio is mathematically structured to outlast the madness. And truth number 8, time in the market always beats timing the market. This is the absolute golden rule of wealth accumulation. The phrase time in the market beats timing the market means that the total number of years your money sets quietly compounding is infinitely more powerful than trying to guess the exact right moments to jump in and out of stocks. It is a mathematical certainty backed up by decades of historical data. To understand why this is true, we have to look at the severe math penalties of trying to time the market and the silent compounding power that rewards those who simply stay put. 1. The mathematical trap to trying to time the market. When people try to time the market, they are trying to execute a flawless two-step maneuver. Sell at the absolute top before a crash and buy back in at the absolute bottom. The problem is that the stock market's biggest up days usually happens within days of its worst down days. If you panic and sell during a downturn, you almost always miss the explosive sudden recoveries. Missing just a handful of those best days completely destroys your long-term returns. Take a look at this data looking at a 20-year market cycle. Investment strategy, the S&P 500, the average annualized return stayed fully invested. And the time in the market, 9.8%. Missed the 10 best days, 5.3%. Missed the 20 best days, 2.6%. Missed the 30 best days, down to 0.6%. By trying to avoid the bad days, investors inadvertently miss the best days. Missing just the 10 best days over a 20-year period cuts your ultimate wealth nearly in half. Why time in the market is an unfair advantage? When you focus on time in the market, you are letting the mathematical phenomenon of compounding returns do the heavy lifting for you. Starting with 10 grand at 10%, the first year you gain a grand. The new total will be 11 grand. Year 2, 11 grand, earns 10%, which is 1100. The new total is 12,100. 20 years, 10 grand turns into over 67 grand without adding a single dime. When your money is constantly in the market, you collect dividends reliably, high quality assets, and ETFs regularly distribute cash. When you sit in cash trying to time a crash, you miss out on those dividend payouts. You capture structural corporate growth. Over time, great companies increase their earnings, raise prices with inflation, and buy back their own shares. Your time in the market and source, you capture 100% of the underlying wealth creation. The practical playbook, dollar cost averaging, DCA. If you accept that you cannot time the market, how do you actually deploy capital? You use dollar cost averaging, DCA. Instead of waiting for the perfect moment, you invest a fixed amount of cash on a strict automated schedule. For example, every week or every month, completely ignoring whether Mr. Market is having a manic or depressive day. If the market is low, your fixed cash buys more shares. If the market is high, fewer shares automatically. This mechanical approach turns market volatility into your best friend. When prices drop, your automatic contribution naturally scoops up shares at a deep discount. You don't have to guess the bottom because your process ensures that you are constantly accumulating weight. Trying to time the market requires you to be right twice, once on the sell and once on the buy. No one, not even the biggest hedge funds on Wall Street, can do that consistently. By prioritizing time in the market, you remove pressure of being a psychic. You accept the current market price, trust the long-term weighing machine, maintain deep cash reserves for safety, and let time turn a modest capital base into generational wealth. Truth number 9. Stock market prices tell me nothing about the fundamentals or the quality of a company, rather the emotional state of traders. This is the ultimate bridge back to Benjamin Graham's Mr. Market allegory. When you say that market prices tell us nothing about the fundamentals, but rather the current emotional state of people's fear and greed, personally, I completely agree in the short term. Price and value are rarely the same thing in real time. The daily ticker price is not calculated math formula based on balance sheets. It is a real-time psychological thermometer measuring human emotion. Here is elaboration on exactly why price reflects psychology over substance and how to spot when fear is driving the machine. The price mechanism, a mirror of human emotion. If a stock price drops 5% in a single morning, did the company's factories suddenly become 5% less efficient? Did 5% of their customers vanish overnight? Of course not. The fundamentals of a business change slowly over quarters and years, but stock prices change every millisecond. That massive gap between slow-moving business reality and fast-moving price action is filled entirely by emotion. How fear distorts the price. Fear is the most potent emotion in the market because humans are structurally wired for loss aversion. The psychological pain of losing $100 or $1,000 feels twice as intense as the joy of making $1,000. When a macro headline hits, real triggers a survival reflex. Investors stop analyzing the company's free cash flow or intrinsic value. Instead, they focus on self-preservation. They vote to sell immediately to stop the perceived pain. When thousands of people do this simultaneously, the price collapses, reflecting maximum panic, not a structural shift in the business's earning power. 2. The illusion of information. A common trap is assuming that a falling price is a signal that something is wrong with that business. It rarely is. Usually, it is just a sign that someone else is forced to sell, running out of cash reserves, or panicking. Like Warren Buffett said, price is what you pay, value is what you get. Exploiting the emotional state. Once you accept that short-term prices are driven by fear and greed rather than fundamentals, you gain a massive competitive advantage. You stop looking at a fallen ticker symbol with anxiety, and you start looking at it as a mispricing opportunity. When a macro news hit, panic and fear, irrational selling, the price plummets below intrinsic value. Right there, the buying opportunity. The framework, intrinsic value versus market price. To separate emotion from reality, an intelligent investor looks at the market through a dual lens. What Mr. Market shows you, the price. What your research shows you, the value. Driven by fear, greed, and hype. Driven by earnings, cash flow, or assets. The first one, high volatile, changes second by second. The second, highly stable, changes slowly, quarter by quarter, measures liquidity and human psychology. The second measures business performance and economic moat. When you are running cash flow or option strategies, understanding this emotional pricing is critical. When fear spikes, option premiums skyrocket because investors are panicking and buying insurance to protect their portfolio. A disciplined investor who keeps deep cash reserves can step in, capture those inflated premiums driven by fear, and let the option decay safely as calm inevitably returns to the market. Daily market prices tell you absolutely nothing about what a business is worth. They only tell you how much it costs to buy or sell that business at this exact second. By treating the price as an emotional readout of the crowd rather than a financial oracle, you can keep your head cool. Stay patient and let the crowd's fear fund your long-term wealth. And last but not least, truth number 10. The market is a device to transfer money from those who buy on technicals to he who buys on fundamentals. This on one of the most polarizing and fiercely debated battles in the financial world. Technical analysis, chart patterns, price trends, and indicators versus fundamental analysis, earnings, cash flow, and business value. We say that the market will transfer money from those who buy on technicals to those who buy on fundamentals. The core sentiment could be right, but there is a major real-world distinction based on time horizons. If you're looking at a long-term compounding of wealth, the market structurally favors fundamentals. Here is an elaboration on why this wealth transfer happens and how both methodologies interact. Why the long-term transfer favors fundamentals. The core reason this wealth transfer occurs goes back to Benjamin Graham's weighing machine. A technical analyst looks at the stock chart and sees patterns, support levels, resistance lines, and moving averages. They are trying to predict the psychology of the crowd in the short term. They believe that the chart tells them everything they need to know about supply and demand. The fundamental investor, on the other hand, ignores the lines on the chart and looks at the underlying business machinery. The technical trader versus the long-term investor. The technical trader focuses on chart patterns and short-term momentum, voting machine. The long-term wealth transfer. The fundamental investor focuses on free cash flow, earnings, and asset value. The weighing machine. The breakdown of patterns under macro stress. Technical patterns work reasonably well when the market is calm and trending smoothly. But when a sudden macro shock hits or an unexpected earnings surprise occurs, those chart patterns melt away instantly. A technical trader who bought a stock simply because it was above its 200-day moving average is suddenly forced to cut their losses and sell when a panic hits. Who buys those shares from them? The fundamental investor, who knows that despite the ugly chart, the company's balance sheet is rock solid and its intrinsic value is much higher than the panic price. 2. The friction of active trading. Technical analysis almost always requires frequent trading to manage risk, using tight stop losses. This constant buying and selling introduces heavy friction costs, slippage. The difference between the expected price and the executed price. Short-term capital gain taxes, which can eat up a massive portion of annual returns. The fundamental investor minimizes it, this friction by buying and holding. By avoiding the trading tax, more of their capital stays in the market to compound over time. The catch: when technicals actually matters. While long-term wealth is undeniably built on fundamentals, it is a mistake to completely dismiss technical analysis, especially if you run active income or options strategies. Legendary macro investors often use a hybrid approach where fundamentals dictate what to buy and technicals helps dictate when to buy or sell. Analysis type core question, real world application. Fundamental. Is this a high quality business with strong cash flow at a fair price? Dictates if a stock belongs in your portfolio. Prevents you from buying garbage company just because the chart looks hot. Technical. Is this stock currently overbought, oversold? Helps you pick entry points. For instance, if you want to write cover calls, doing so when a stock is testing a major historical resistance level can maximize your premium. If an investor relies strictly on technical analysis without understanding the underlying company actually does or earns, they are essentially playing a high-speed game of musical chairs. Eventually, the music stops. The short-term voting machine shuts down and the weighing machine takes over. By anchoring your core capital to fundamentals, ensuring your own productive, high-earning assets backed by deep cash reserves, you put yourself on the winning side of the wealth transfer. You let the technical traders absorb the short-term volatility and friction, while you sit back and capture the long-term corporate growth. That was the last truth from The Intelligent Investor. I always think of chapter 8 of The Intelligent Investor before I place trades. And now I hope that you guys do too. Well, thank you so much for being with me up until the end. Thank you very much again. If you have any questions, comments, feel free to reach out. I'm here for you guys. Peace out.